Hey, it's Brendan here from Infinity Investment Solutions. And I think it's time I start making videos again. Why now? Well, there's a few reasons. So number one is the market's obviously changing dramatically. And that presents significant opportunity as well as a little bit of risk. So how are we applying ourselves to be able to manage those risks and take advantage of those opportunities? Number two is one of the questions I asked myself with creating these videos is, how can I share something of value that you can use in your life that you can't learn from somewhere else? Because obviously there's a lot of people producing mountains and mountains of content. I mean, there's an information deluge available. And, you know, if I'm going to be a part of that information stream that's coming into your feed, how do I differentiate what I'm teaching or what I'm sharing and the strategies we're learning and deploying in order to create wealth and keep buying, even though the market's going a little bit crazy, you know, that you can then use in your own personal life to make a difference? Because I don't want you to waste time watching this video that you could have just learnt the same thing from somebody else, like a Robert Kiyosaki or a Meet Kevin or a Grant Cardone. And I mean, I highly recommend that if you are trying to get results, go learn from some of those good quality people. They're out there and they're doing good things. They've got great courses available. And I think they're very, very good teachers and mentors. I mean, there's great guys out there that are teaching very, very good quality stuff. So I want to try and share with you something that they might not be teaching. So let's take an example today. So one of them that I've been getting asked a lot lately is I want to get into the property investment game. Brendan, I see you've done a lot over the last 12, 15, 20 years. We've built a big portfolio over there. How do I get started? And should I wait until the market's bottomed out? And I'm like, no, that's the worst decision ever, to wait until the market's bottomed out to get into the market. And I'll give you a few reasons why. So one of them is you're never going to time the market right exactly. Never. So you got to get that out of your head, especially if you haven't been in the market. So if you're a novice investor thinking that you can time the market right because there's so much noise that's going on in the news right now on what's happening in the market, that, oh, it's going down and, you know, prices are going down and you should wait and interest rates are up and all the rest of that stuff, is the worst thing you can do is not be in the market. It's not about timing the market. It's about time in the market. And why is it about time in the market? So this is what happens. So the second question people ask me is, where do you get deals from? Well, the only way you get deals is you build a track record, a good quality track record that you close, that you don't renegotiate very much, that you don't mess sellers around, that you have a good reputation, that when you go under contract, you close on the deal without messing people around. That's number one. Number two is, the only way you get the deal feed in is after you have closed on deals. Because people aren't going to phone you if you're the first person that says, oh, I'd like to buy something, when it's the perfect timing in the market and it's the cheapest it will ever be, and I've only got so many dollars to spend, and I don't know how to get the finance, and I don't know how to manage the property, and I don't know how to get staff to look after it, and you know, all of those things. That means you're never going to get that call from the broker that says, hey, here's an amazing deal, I think you should buy it right now. The reason we get those calls is because we've been in the market for, in the US, for example, for 12 years. And we've got partners that have been in the market for 20, 30, 40 years. So they're bringing us deals because we've got a reputation of always closing and that we don't mess people around. That's why we get deals. And it's because we've been in the market for so long. So how did we start? Well, we started small and we just bought a little house and then bought another house and then helped somebody else buy a house. And then I helped a few investors buy houses. And then we bought some medical buildings and then we bought some multifamily and then we did a development. So it built up over time to what it is now, where it's, you know, a few $100 million that we have under management. But it starts with being in the market. You don't get deals in your inbox that are worth buying unless you're in the market. So you have to start. The other thing is, if you're trying to time the market, and let's say the market's at the top it's ever been and it's on its way down, right? If it's on its way down and you're like, okay, well, it's come down a little bit. Let's say it's down 10, 15%. You're like, well, if I keep waiting, maybe I can get it at 20% off, and then I can negotiate with the guy and maybe get it at 30% off, or whatever the case may be. But you're not going to get that call, number one, as I said earlier. But let's say you do get the call and you're actually trying to time the market and get it at exactly the right price in order to make the move and take action and actually buy the property. Well, what's going to happen is somebody else is probably going to get the call and somebody else is going to buy the property. But let's say you are there, right? If you're trying to time it perfectly, you're not going to know if you're making the right decision or not. So you're going to have this hesitation on whether you should or shouldn't or take action or not, because you're not sure if it's the right time in the market. However, if you know you're buying over the long term, then the price you pay is not the only thing you should be focusing on. While it's important, it's not the only important factor. The key factor here is you want to have time in the market. So if you're buying on the way down, right? So let's say you buy a property here that's 20% below its peak value and its market value in today's market. And then you buy another one that's maybe 10% below that a year later. And then you buy another one that's maybe 10% below that another year later. So you've been in the market for 3 years and you bought maybe 3 properties. But over that time period, if you dollar averaged on your way down, you'll find that you've actually more or less timed the bottom of the market fairly well across 3 properties or 4 properties or 5 properties. And you've now built a bit of track record to be able to continually get deal flow into your inbox. So then you've got a property here, a property here, a property here. But now you've got 3 properties that when the market turns around again and it starts riding back up, now you've got 3 or 4 or 5 properties that are starting to grow in value. That's phenomenal. And it also means on the dollar average on the way down, you've got a lower basis across the portfolio than you would have had if you only bought the 1 property and you tried to time it perfectly. So that's a very valuable lesson, as you want to be in the market to get the deal flow, but you also want to be in the market continually buying on the way down, because if the stuff that you want to own over the long-term period of time is getting cheaper and cheaper, you want to load the truck up with that stuff. You want to be constantly buying and not selling your gems, to load the truck up so that when the market turns around, you've got as many assets under management as possible, so that when that value shift happens, it's significant and it makes a huge difference to the bottom line. When the asset value is not $1 million or $2 million, maybe it's 10 million or 20 million that grows. And if you've got a 10 million portfolio that grows 10%, let's say your basis was 10 million, it grows 10%. Well, that's $1 million. That makes a difference in people's lives. Well, depending on your lifestyle. I mean, $1 million for some people isn't a lot of money. For me, it's still a lot of money. But if you only had that 1 property that you tried to time perfectly, let's say you bought it for $1 million, right? And you tried to time it perfectly, but it went down in value another 10% over 2 years, and then it turned around and went up 10 or 15%. So it went down to 900 and then it went back up to 990. Well, now you've had no real value growth or value upliftment whatsoever. Whereas if you built a $10 million portfolio and you averaged it on the way down and that thing moves 10%, well, now you made a significant change to your life in the movement on the value of the portfolio. The other thing is the price point. So when you're trying to time the market and get the price point perfectly, oftentimes the price isn't the thing that necessarily matters. Terms matter. So can you buy a property with different terms instead of focusing on the price? That's a whole nother video that I'll go into at another stage. But on the price point, like, let's think about things a little bit logically. If your intent is to own a property for a long period of time, pay off the debt and have the income in order to, live off the cash flow in future. And obviously this is a thing that I highly advocate, is living off the cash flow of the properties, not on the capital, the cash flow. The capital is there to milk. You want to refinance, take that out, go buy another property and keep that going to build a big asset base. But the cash flow, that's what you want to spend. That's what you want to spend on nice cars and holidays and, all the fun stuff. So the price point, let's just analyze that for a second. Let's say you bought a property for $1 million, right? And its value today was $1 million. So you didn't overpay, but you didn't get a good deal. You just bought it for market value of what it is today. And you put down 30% deposit, because that's a standard vanilla transaction, and you borrowed $700,000 from the bank. So you put down 300 grand, you borrowed 700 grand, and there's enough income there for the tenant to service your debt and your maintenance and your expenses for, let's say, the period of the bond. So I'm not going to break my brain or run a spreadsheet here just for example or educational purposes. I'll just do the stuff in my head and hopefully it'll be reasonably accurate. But let's say there's enough rental income to service the bond and just pay it off over the next 15 to 20 years. Generally, if you've got rental increases that are inflation related over 10 to 15 years, you can pay a property off in roughly 15 years if you're just getting very average returns. So if you took $300,000 and the tenant paid the property off, so the other 700 was paid by the tenant over 15 years, which is a long time to wait, but it's let's think about the example for a second on the numbers and not so much the time. Well, if you turn 300,000 into $1 million, do you think that $1 million property is going to be worth more or less in 15 years time? Let's say it doesn't change value at all and it stays at $1 million. How many properties would you like to buy for 300,000 that are worth 1 million and only put 300 grand in out of your back pocket? I want to buy as many as I can get my hands on because I know the property values are going to go up. Why? Because inflation is your friend in property. What's also going to happen is inflation is going to devalue your debt over time, which is phenomenal because you want to be paying the debt back with future inflated money so that your debt's worth less and less every year based on inflation. I'm saying it badly, but hopefully you're getting the idea here. Is your debt is being eaten in value by the inflation, while inflation is pushing the value of your property up over time. So if I can buy 300 grand, a $1 million property for $300,000, and the tenants paid the other 700, and even if it doesn't change value, I've still 3x'd my money. I want to do those deals all day long, every day, twice on Sundays. So the price point is not necessarily the thing you need to fixate on. Let's say you overpaid for the property and you paid $1.1 million and it was only worth 1 million. Well, if I turn 300 grand into $1 million in value, even though I overpaid for the property, it doesn't matter so much. Yes, we want to get the best price possible when we're negotiating to buy, but it doesn't mean that you should not buy the property. You should absolutely buy the property if the numbers make sense and do the best you possibly can on the price, but don't let it be the only thing that determines whether you pull the trigger or you don't pull the trigger. So anyway, I thought I'd leave you with some of those thoughts today. I'm going to try to do a lot more videos of this nature in future to share with you some of the thinking behind how we make decisions and why we make decisions on the properties we're looking at. We've got quite a sizable portfolio under management. We're learning every single day on what to do and what not to do and how to manage the risks in this environment. And it's been a lot of fun. So I hope you found this valuable. If you did, please share it, like it, do all of that stuff. If you didn't, that's okay. Thank you very much for watching. Take care. Bye-bye.